Hello friends, my name is Behroz and welcome to my channel where we talk about how we can live our best lives and be our best versions. Now in my last video with the link above, I talked about why S&P 500 Index ETF is one of the best investments within the stock market. As a response to that video, I received a number of questions from my followers asking me to also talk about what is the best time to invest in the market, especially given the recent volatility. In order to time your investments in the market, I make use of and also prescribe two methods which I use hand in hand. The first method I will share and explain in this video, and for the second method I will make a separate video for which I will leave a link above. The first method that I will talk in this video is called dollar cost averaging, which is primarily intended to ensure that your investments always achieve or surpass the average market returns. And the best part of this financial strategy is that it reduces the impact of volatility that comes from large purchases of financial assets such as equities. Now this is how it works. Suppose you are an investor and you have $100,000 to deploy and invest in the stock market. You can choose to invest the entire amount in one lump sum by timing the market. But your investment returns will be highly dependent on the level at which the market is at the point in time you make that particular investment. Because there is a timing risk involved here, which comes into play every time the market takes a cyclical dip of more than 10%, which frankly is a very normal occurrence once every other year. Now making all my $100,000 worth of investment in one go just before the market takes a 10% dip is something that I won't be psychologically able to digest and would surely have a serious nervous breakdown. And by the way, this dip could be even bigger than the 10% as we've seen in the financial crisis of 2009 or during the COVID. Another option is that you wait for the market to dip completely and reach a bottom. The issue with that is no one knows when and if that will happen. You might keep waiting and miss some good gains in the market and dividend income that comes consequently. And when and if a significant dip comes along, it will be very difficult to say whether the market has reached its bottom or there is more dip to come after this. Because let's say if I enter the market and invest all my wealth in that dip, but the market continues to fall and drop further from that dip, that would be something again that would be psychologically impossible for me to digest. Alternatively, we can use the dollar cost averaging method, which is my recommended approach in order to minimize the market timing risk. According to this approach, you can deploy your $100,000 in equal amounts over a period of time in the market. For example, you can invest $1,667 every month, which is $20,000 every year for a period of 5 years, and it will add up to $100,000 invested over a period of 5 years at different point in time. In this way, you will be buying in the market when the market is going up and enjoy the gains from a bull market along with the dividend income, while also get a chance to buy into the dip when it happens. As a result, you will average out the cost price of your investment. Mathematically speaking, this method is more weighted towards the dip because you can buy more shares when the market is dipping with the same number of dollars. As a result, dollar cost averaging can significantly reduce the total average cost per share of your investment, giving investors a lower overall cost for the shares purchased over time, hence allowing for higher gains once the market is recovering. Dollar cost averaging method seeks to reduce risk of incurring a substantial loss by investing your entire lump sum of money just prior to a market fall. Now, this method may not be the most profitable way to invest a large sum of money. That is to say that you will not be able to significantly outperform the market. However, surely you will minimize the downside risk. Now let me share with you some numbers to prove my case, where I will share with you outcome of different investment scenarios. Let's say if you invested $100,000 over 5 years in 60 equal monthly installments starting 2007, that is prior to the start of financial crisis. By end of year 2021, which is in 14 years from the first investment that you've made, you would have made 3.6 times of your initial investment, that is approximately $360,000 for an investment of $100,000. But at the same time, your investment would run a maximum downside risk of 17.7%. That is to assume you were to sell all your investments when the market was lowest during this period, which is during the financial crisis. However, in case you invested all your money in lump sum at start of 2007, you would only make a multiple of 3 times, but run a downside risk of 48.6%. Because in this case, since you invested the entire amount in one go, that entire amount is at risk of facing the downside once the crisis hits. Now at scenario 3, in case if you were able to pick the lowest point in the market, which was March 2009, which I would frankly argue be just impossible to do, the portfolio would have appreciated 5.8 times by end of 2021. And the fourth scenario, which is in case you invested all your money in lump sum just before the financial crisis, you would have made 2.8 times your investment by the end of 2021. However, at the same time, running a downside risk of 52%. This is because your entire investment, which has been done in one lump sum, is at risk of seeing a dip in one go. Now note, in these scenarios, I make use of global financial crisis of 2009 as a real life example of significant market dip. Such dips, while no one can predict, are not avoidable since markets maintain a cyclical pattern. Clearly, I would choose the first option of investing in 60 equal installments, which applies the dollar cost average approach, since it offers the highest returns with least exposure, or call it the drawdown risk. There is greater return in case one invests just prior to a major dip. However, such a timing is impossible to predict or even estimate. So that scenario is frankly not realistic at all. Thank you for watching this video. I hope this was helpful for you to now start making wise investment decisions.